Welcome friends. In today's video, let's learn why interest rate matters to forex traders. Interest rates make the forex world go round. In other words, the forex market is ruled by global interest rates. A currency's interest rate is probably the biggest factor in determining the perceived value of a currency. So, knowing how a country's central bank sets its monetary policy, such as interest rate decisions, is a crucial thing to wrap your head around. One of the biggest influences of central bank's interest rate decision is price stability or inflation. Inflation is a steady increase in the prices of goods and services. Inflation is the reason why your parents or your parents' parents paid a nickel for a soda pop in the 1920s, but now people pay 20 times more for the same product. It's generally accepted that modern inflation comes with economic growth. However, too much inflation can harm an economy, and that's why central banks are always keeping a watchful eye on the inflation-related economic indicators such as the CPI and the PCI. In an effort to keep inflation at a comfortable level, central banks will most likely increase interest rates, resulting in lower overall growth and slower inflation. This occurs because setting high interest rates normally force consumers and businesses to borrow less and save more, putting a damper on the economic activity. Loans just become more expensive while sitting on cash becomes more attractive. On the other hand, when interest rates are decreasing, consumers and businesses are more inclined to borrow, boosting retail and capital spending, thus helping the economy to grow. What does this have to do with the forex market? Well, currencies rely on interest rates because these dictate the flow of global capital into and out of a country. They are what investors use to determine if they will invest in a country or go elsewhere. For instance, if you had your choice between a savings account offering a 1% interest rate and another offering 0.25%, which would you choose? You would pick the 1%, right? We hope so, because 1% is bigger than 0.25. Currencies work the same way. The higher a country's interest rate, the more likely its currency will strengthen. Currencies surrounded by lower interest rates are more likely to weaken over the longer term. Pretty simple stuff. The main point to be learned here is that domestic interest rates directly affect how global market players feel about a currency's value relative to another. That's all for today. Let's catch up in the next video with more interesting content. Until then, take care. Bye-bye.